Gold just got wrecked, down 9% in a single day. Silver straight up nuked, down 35%. $7 trillion. Poof, gone in 24 hours. One of the oldest safe assets on Earth just had one of the nastiest wipeouts ever. And the wildest part, nothing major actually changed. The world didn't suddenly become peaceful, inflation didn't disappear, central banks didn't wake up and rewrite the whole playbook, but gold still got absolutely smoked. So, what the hell just happened? And more importantly, what does it mean when the thing people run to for safety ends up blowing up their accounts? Let's be real about the scale here. This wasn't some cute little dip or a healthy pullback. This was violent, the kind of move that wipes out accounts, triggers margin calls, and sends traders into full-blown panic mode. We're talking about precious metals, the stuff people buy because it's supposed to be boring and stable. Gold isn't supposed to crash, until it does. And this didn't come out of nowhere. For months, honestly years, gold had been on a heater. Every geopolitical mess, every inflation scare, every whisper about a weaker dollar sent more money rushing in. Financial media was screaming about new all-time highs. Crypto bros suddenly turned into gold bugs overnight. And that one uncle who lives on cable news, yeah, now he's talking about bullion like he uncovered some elite conspiracy. The story was perfect. Way too perfect. Here's how it went down. Gold was hanging near record highs. Silver was riding pure momentum. Then Kevin Warsh gets named as the likely next Fed chair. Not even officially appointed, just named as the pick, and the market absolutely lost its mind. Within hours, gold started dumping, not slowly, dropping like a rock. By the end of the day, gold down 9%. Silver, which is always extra spicy, got demolished, down over 35%. Traders were staring at their screens like there's no way this is real. $7 trillion in precious metal value erased. And here's the weird part. Warsh isn't some mystery guy. Everyone knows who he is. Yeah, he's considered hawkish, but it's not like this was some shocking outsider who flipped the whole economy overnight. But markets don't care about nuance. They care about stories. And the story flipped instantly. Normally, big corrections happen when something real changes. Bad earnings, terrible economic data, surprise rate hikes, something you can point to and say, yeah, that makes sense. This wasn't that. This was a crowded trade explosion mixed with a liquidity crunch and a big scoop of straight panic. Gold had become insanely crowded, not just popular, packed wall to wall. Hedge funds, retail traders, momentum chasers, everybody piled in. And a lot of them weren't just buying gold, they were buying it on leverage, borrowed money, margin, futures, stuff that makes you look like a genius on the way up and absolutely ruins you on the way down. When a market's overbought and stuffed with leverage, you don't need huge news to trigger chaos, you just need a spark. Then the mechanics take over. Stop losses hit, margin calls roll in, forced selling starts, prices drop more stops get triggered, more liquidations. Boom, vicious feedback loop. So why did Warsh's name set this off? Because the market had been pricing in chaos, runaway inflation, clueless central banks, total uncertainty. Gold thrives on fear. It's basically the OG panic trade. But suddenly the narrative shifted. Warsh signaled structure, predictability, a Fed that might actually focus on price stability. Doesn't even matter if that's true. Perception is everything. Suddenly, people asked, If things might stabilize, why are we paying record prices for shiny rocks? And the honest answer? Most people weren't buying gold because of deep macro analysis. They bought it because the chart went up. And when charts stop going up, especially with leverage, people hit sell fast. Gold didn't fail as a safe haven. It failed as an overcrowded, over-leveraged trade. Huge difference. Safe havens work unless you're forced to sell at the worst possible time. And if you're buying safety with borrowed money, you're not buying safety. You're buying risk wrapped in gold-colored packaging. Who actually got wrecked? Not central banks stacking gold quietly for decades, not old money families with bars locked in vaults. It was the momentum chasers, the late arrivals, the FOMO crowd. They bought because everyone else was buying. They sold because everyone else was selling. That's not investing. That's herd mentality with a brokerage app. So what now? Is gold finished or just bruised? The bullish case is still alive. Central banks keep buying, global tensions aren't going away, U.S. debt is still messy, rates could fall, the dollar could weaken. All bullish long-term. But here's the bearish reality. Gold is expensive, like historically expensive. Even adjusted for inflation, it's near record levels, higher than 1980 and 2011 peaks. And historically, when gold gets this pricey, things don't end quickly or smoothly. After 1980, 2 decades of sideways action. After 2011, nearly 10 years to recover. Gold doesn't produce cash, no dividends, no earnings. It just reflects whatever emotion, fear or greed dominates the market. And even after this crash, it's still expensive. This isn't just about gold. It applies to everything. Crypto, tech stocks, real estate, whatever's hot. When everyone agrees something is a guaranteed win, when the narrative feels untouchable, when people stop asking tough questions and start buying out of FOMO, that's when risk is highest. Not because the asset is garbage, but because positioning is broken. Gold isn't a scam. It has a place in portfolios, but it's not magical. It doesn't ignore gravity. And yeah, it can absolutely wreck you if you buy it at the wrong time for the wrong reasons. The winners bought early, stayed patient, and didn't get greedy. The losers showed up late, used leverage, and convinced themselves this time is different. It never is. So, is the gold bull run over? Maybe, maybe not. There are too many moving parts to know for sure. But one thing is clear. The easy money is gone. The momentum trade is broken. The crowd got flushed out. What happens next depends on why you owned gold in the first place. Because you believe in the fundamentals, or because the chart looked sexy. Gold doesn't care either way. It'll just sit there, doing what it's always done, reflecting our fears back at us. Sometimes that makes you money. Sometimes it wrecks you. The real skill is knowing which one you're looking at before you place the bet.